Hi everyone, and welcome to today's lecture on Capital Cost Allowance, or CCA. Let's first understand what CCA is. If you own a small business, or earn self-employment income, or have a corporation, then you must understand what CCA is and how it impacts your tax return. To run a business, we all need to make some big purchases, like buying a machinery, or a truck, or a laptop, or a printer. These items are called capital assets of a business, and they cannot be deducted all at once on your tax return, because it's one-time, big investment purchases that lasts for more than a year. Instead, it can be deducted in installments on your tax return, called CCA, and there is a separate calculation for it. Each type of capital asset has its own bucket of percentage that is used to calculate the amount. These buckets are called classes. For instance, let's say you bought a furniture. Then, it would go in Class 8 bucket. This class has a fixed percentage of 20%. Or, if you bought a car, then it would go in Class 10 bucket. And this class has a fixed percentage of 30%. And so on. Here's the CRA link, where you can find out buckets for each type of capital assets and its percentage. Let's go over an example. Let's say you bought a laptop for $2,000. This would go in Class 50 bucket, which has a fixed percentage of 55%. So your calculation will start with a purchase of $2,000. Now, here's an additional rule. The year you buy the capital asset, you need to calculate the percentage on half cost of the item. Ideally, we would calculate the amount as $2,000 multiplied by 55%. However, due to the half-year rule, we can only calculate on $1,000, that is half of original purchase price, that is $2,000, in first year. So, the calculation will be 55% of $1,000, that is $550. This $550 is called CCA, which can be deducted on your tax return, and not the full $2,000 that you spent on buying the laptop. Now, you must be wondering, I spent $2,000, but I can only put down expense of $550 on my tax return? So, what happens to the remaining expense of $1,450? Don't worry, you will be able to use the remaining expense in future tax returns when you file them. Now, let's go back to our example to understand better. We know we already claimed $550 expense on this year tax return. What's the balance? $2,000 minus $550, $1,450 is still pending to be claimed. Now, when you file next year tax return, you can again calculate 55% of $1,450, which is $797 CCA, and put it down on your tax return as $797 expense. You can repeat the same calculation on remaining balance until complete $2,000 is claimed on your tax returns. Now, you will say, how will I keep track of it each year? Good point. There is a form called Schedule 8, which keeps the track for you, so you don't have to worry about it. This is what the form looks like. Firstly, there's the class number, which is the bucket. In our case, it's Class 8. Then UCC means your opening balance. In our case, it's $2,000. This is the CCA. In our case, it's $550. And ending UCC means ending balance. In our case, it's $1,450 for first year. Now, let's say next year, you buy another laptop, so it will go in the same bucket, that is Class 8 bucket, and will be added in this column, here, for the calculation. Let's say you sold your old laptop, the disposal will go here, in this column to do the calculation. The rest of the columns gets automatically calculated once the basic amounts that we discussed are entered in the form. The good part is that the software does the calculations for you, so you don't need to scratch your brain every time you buy or sell your laptop. All you need to do is understand the logic and which class it belongs to, and where the purchase and sale numbers would be entered in the form, so that the software can calculate correct numbers for you. Now, you may have a situation where you decide to sell the laptop. You may sell it for more. For instance, the laptop that you bought for $2,000 and claimed $550 CCA already. Now when you sold it, you received $2,000 for it. In this case, CRA will say that you already claimed expense of $550 on your tax return, and now you got that money back when you sold it. So you have to add $550 as income in your tax return. This is called recapture. Alternatively, you may have a situation where you sold the laptop for less. Say, you sold it for $1,000. In this case, out of $2,000, you only claimed $550 in the past on your tax return, then received only $1,000 when you sold it. So remaining $450 is your loss, which you can deduct as expense on your tax return. This is called terminal loss deduction. If you're a sole proprietor, you can use Form T2125 and claim the CCA under this form. I've made a separate video for T2125 form on how to fill it out. Feel free to check it out. I'll drop the link below in description. And if you're filing a corporate tax return, then you can fill out Schedule 8 on the tax return. It can be found in the tax software. Here's an helpful tip. Claiming CCA as an expense on your tax return is optional. That is, you don't have to claim that expense on your tax return if you don't want to. It's part of the tax planning that chartered accountants use if they want to save future non-capital losses. Let's go over the same example to understand better. Let's say your business just started and did not make much income in year 1. You made $100 income, and $100 is your general expenses, excluding the laptop expense of $2,000. Now, we already calculated that you can claim $550 of CCA expense on your tax return. Let's say you claimed it, then you end up having a loss of $550. Simple math. Income minus expense. Now, this loss of $550 can be used in future when you make profit. Say, next year you make income of $100. To keep the example simple, you don't have any expenses, and you have to pay tax on $100 income. Now, you can avoid paying tax on it by using loss from prior year. Remember? We have a loss of $550. Let's use $100 from it to make the income zero, so we don't have to pay tax. We still got $450 of loss that we can use in future against income, so we don't have to pay tax again. Now, how long can we do that? Here's the twist. We can only use it for 20 years in future, then it expires. So if the business is not making profit for the next 20 years, then we don't have a chance to use the loss. And after 20 years, even if the business makes profit, the loss has expired. However, instead what the tax planners usually do is they don't claim CCA if they don't have to, as there is no expiry for the CCA bucket. So, if you need the CCA expense after 20 years, then you can claim it at that time. Instead of creating a loss now and having a ticking time bomb for its expiry, we can save it for future. Check out my capital and non-capital loss video for more details on how the losses work and for some tax planning tips. Hope you have a better understanding of what CCA is and how it works. That's all for this video. If you have any questions, comments, or would like me to explain any other tax topic in detail, please feel free to drop a comment below. If you found this video helpful, please give it a like, hit that subscribe button, and share it with your friends who could really use a hand. Good luck. Bye for now.